All right, let me walk you through something that's happening right now, and I need you to pay close attention because what I'm about to share is not speculation, it's not theory, and it's not another retirement planning pep talk. This is about a structural shift in the American retirement system that has already begun, and most people won't understand the implications until it's too late to adjust. According to data released by the Bureau of Labor Statistics in January 2025, 22% of Americans who had fully retired are now back in the workforce. That's not 22% of retirees considering going back. That's 22% who have already returned. We're talking about over 4 million people who thought they were done working, who had run the numbers, who had consulted with financial advisors, and who believed they had saved enough, now finding themselves back behind a desk or a cash register or a steering wheel because the math stopped working. And here's what makes this different from any previous trend we've seen. This isn't about retirees going back to work because they're bored or because they want social engagement. This is about financial necessity driven by a combination of inflation that has not returned to historical norms, healthcare costs that continue to compound at rates far above general inflation, and a sequence of returns problem that has devastated portfolios for anyone who retired between 2020 and 2023. Over the next several minutes, I'm going to break down exactly why this is happening, what the specific mechanisms are that are forcing retirees back into the labor market, and most importantly, what you need to understand right now if you're within 10 years of retirement or if you're already retired and feeling the pressure. This is not about fear. This is about understanding the rules of the game that have changed and making sure you're positioned correctly. So stay with me because by the end of this, you'll have a framework that most financial advisors are not equipped to give you. Before we go further, you need to understand the foundational concept that governs whether a retirement plan works or fails, and it's something called the sequence of returns risk. Most people think retirement planning is simple math. You save a certain amount, you withdraw a certain percentage each year, and as long as your portfolio averages a reasonable return over time, you'll be fine. But that's not how it actually works. The order in which you experience investment returns matters enormously, especially in the first 5 to 7 years of retirement. If you retire into a market downturn and you're forced to sell assets at depressed prices to fund your living expenses, you permanently reduce your portfolio's ability to recover even when markets eventually rebound. Let me make this concrete. Imagine two retirees, both with $1 million, both withdrawing 4% annually adjusted for inflation, and both experiencing the exact same average returns over 30 years. The only difference is the order. Retiree A experiences strong returns in the first decade and weak returns later. Retiree B experiences weak returns first and strong returns later. Retiree A's portfolio lasts the full 30 years with money left over. Retiree B runs out of money in year 23 despite having the identical average return. This is not theoretical, this is mathematical certainty. And right now we have an entire cohort of retirees who retired at market peaks in 2021 and 2022, experienced the 2022 drawdown where the S&P 500 dropped 18% and bonds simultaneously fell, and are now locked into a sequence that has already damaged their long-term sustainability. The thesis here is straightforward. We are witnessing the first wave of a structural retirement crisis, driven not by a single catastrophic event, but by the compounding effects of inflation persistence, healthcare cost acceleration, longevity risk, and portfolio sequencing failures. The 22% return to work rate is not an anomaly. It's the leading edge of a much larger cohort that will face the same pressures over the next decade. And if you don't understand the mechanics of why this is happening, you cannot protect yourself from it. Let's start with the historical context because this pattern has precedent and the outcomes are predictable if you know where to look. The first parallel is the stagflation period of the 1970s and early 1980s. During this time, inflation ran at levels we hadn't seen since the immediate post-World War II period. In 1974, inflation hit 11%. In 1979 and 1980, it exceeded 13%. For retirees on fixed incomes or conservative portfolios, this was devastating. A retiree who had built a nest egg designed to last 25 years based on 3% inflation assumptions found that their purchasing power was being cut in half every 6 years instead of every 24 years. The rule of 72, which tells you how long it takes for a value to double or in reverse how long it takes for purchasing power to halve, became a brutal reality. At 12% inflation, your money loses half its value in just 6 years. Retirees who had retired in the late 1960s with what seemed like adequate savings were forced to make impossible choices by the mid-1970s, cut spending dramatically, return to work, or rely on family support. The labor force participation rate for workers aged 65 and older, which had been declining steadily since the 1950s, actually stabilized and began ticking up in the late 1970s. This wasn't because people suddenly loved working longer, it was because inflation had destroyed the assumptions their retirement plans were built on. The investors who navigated this period successfully were the ones who understood that traditional 60-40 portfolios and fixed income instruments were wealth destruction machines in an inflationary environment. They shifted into assets with pricing power, into equities of companies that could pass costs on to consumers, into real assets like real estate and commodities, and into inflation-protected instruments where they existed. But most retirees didn't make that shift in time because the financial services industry was still selling the same playbook that had worked in the 1950s and 1960s. The second historical case is less discussed but equally important, and that's the early 2000s, specifically the period from 2000 to 2010, which is often called the lost decade for stock investors. The S&P 500 began the year 2000 at around 1,470 and ended 2009 at roughly 115, a nominal loss of 24% before dividends. When you factor in inflation, real returns were deeply negative. Now add to this the fact that we had two major bear markets during this period. The dot-com crash from 2000 to 2002, where the market fell over 40%, and the financial crisis of 2008 to 2009, where it fell 57%. Anyone who retired in 1999 or 2000 and followed the traditional 4% withdrawal rule experienced severe portfolio damage. Studies done after this period showed that retirees who began withdrawals in 2000 had a significantly higher probability of running out of money within 25 years compared to almost any other retirement cohort in modern history. And what did many of those retirees do? They went back to work. The labor force participation rate for older Americans, which had been declining for decades, reversed course and began climbing steadily after 2000. By 2010, the participation rate for workers 65 and older had increased by over 30% from its low point. This wasn't a social trend. This was a financial necessity driven by the same sequence of returns problem we're discussing today. Now let's connect this to 2025 and the data we have right now, because the mechanics are repeating with some new complications that make the current situation even more challenging. The 22% of retirees returning to work represents approximately 4.2 million Americans based on Census Bureau data on the retired population. To put that in perspective, that's more than the entire population of Oregon re-entering the workforce after having fully exited. These are not early retirees in their late 50s or early 60s who retired temporarily and decided to go back. The data shows that a significant portion of this group is age 68 to 75, meaning they had fully intended to be in permanent retirement. The primary driver, according to surveys conducted by the Employee Benefit Research Institute and AARP, is straightforward. The cost of living has exceeded their income and they have no other option but to generate additional cash flow. Let's break down the specific cost pressures because this is where the numbers become undeniable. Inflation as measured by the Consumer Price Index peaked at 9.1% in June 2022. Since then, it has moderated to the 3 to 4% range, but here's what most people miss. Inflation is a rate of change, not a level. Prices that went up 20% from 2021 to 2023 did not come back down when inflation moderated. They stayed elevated and continue to grow from that higher base. A grocery basket that cost $100 in January 2021 now costs approximately $125 in early 2026. That's a permanent 25% reduction in purchasing power for anyone on a fixed nominal income. For retirees, the impact is even more severe because their consumption basket is weighted differently than the general population. Healthcare, housing, and food represent a much larger share of retiree spending, and all three of these categories have experienced above-average inflation. Healthcare is the most brutal component. Medicare Part B premiums, which are deducted directly from Social Security payments, increased from $148.50 per month in 2021 to $185 per month in 2026. That's a 24.6% increase in just 5 years. But the premium is only the beginning. Out-of-pocket costs for Medicare beneficiaries, including Part D prescription drug costs, Medigap premiums, and costs not covered by Medicare like dental and vision, have been rising at rates between 5 and 7% annually. The average Medicare beneficiary now spends over $7,000 per year on healthcare costs beyond their premiums, and for those with chronic conditions, that number can easily exceed $15,000. Now layer on the fact that long-term care costs, which Medicare does not cover except in very limited circumstances, have been rising at 4 to 5% per year. The national median cost for a private room in a nursing home is now $108,000 per year. For assisted living, it's $60,000 per year. For in-home care, it's roughly $30 per hour, which translates to over $60,000 per year for full-time assistants. Most retirees have no plan for these costs. They assume Medicare will cover it, which it doesn't, or they assume they won't need it, which statistically 70% of people over 65 will at some point. Let's talk about Social Security because this is the baseline income source for most retirees, and the math here has fundamentally changed. The average Social Security benefit in 2026 is approximately $1,820 per month or $23,040 per year. The maximum benefit for someone who claimed at full retirement age is around $3,800 per month. Social Security has a cost of living adjustment mechanism built in, but it's based on the Consumer Price Index for urban wage earners, which does not accurately reflect retiree expenses. In years where healthcare and housing costs are rising faster than general inflation, Social Security adjustments lag behind the actual cost increases retirees face. Between 2021 and 2026, Social Security benefits increased by approximately 18% cumulatively through COLA adjustments, but as we just discussed, healthcare costs alone increased by over 24% during the same period. This creates a purchasing power gap that widens every year. For a retiree whose only income is Social Security, that gap means choosing between medications, food, or keeping the heat on. For a retiree with investment income or pension income, it means drawing down assets faster than planned, which brings us back to the sequence of returns problem. Now let's examine what happened to portfolios for the cohort that retired between 2020 and 2023, because this is the mechanical explanation for why so many people are being forced back to work. Someone who retired in January 2020 with a balanced 60-40 portfolio, 60% stocks and 40% bonds, experienced the COVID crash in March 2020, where the S&P 500 dropped 34% in just over a month. Markets recovered quickly due to unprecedented fiscal and monetary stimulus, but then came 2022. In 2022, the S&P 500 fell 18%, the Nasdaq fell over 30%, and most importantly, bonds fell simultaneously. The Bloomberg Aggregate Bond Index, which is the benchmark for investment-grade bonds, dropped 13% in 2022, the worst year for bonds in over 40 years. A 60-40 portfolio lost approximately 16% that year. For a retiree withdrawing 4% annually to cover living expenses, this was catastrophic. They were forced to sell assets at the worst possible time, locking in permanent portfolio damage. Let's model this with real numbers. A retiree with $1 million in January 2020 begins withdrawing $40,000 per year adjusted for inflation. After the 2020 volatility, they're still okay because of the quick recovery, but in 2022 their portfolio drops to $840,000 after the market loss, and they need to withdraw $43,600 to maintain purchasing power due to inflation. That withdrawal comes out of a depressed portfolio, meaning they're selling more shares at lower prices. By January 2023, even as markets partially recover, their portfolio is now under $800,000. They've lost 20% of their principal in 3 years, and their safe withdrawal rate, which was 4% at the start, is now over 5.4% in real terms. This is unsustainable. Studies show that withdrawal rates above 5% have a very high probability of portfolio failure within 20 years, and we're talking about retirees who may need their money to last 30 years. The people who are now returning to work are those who ran this math in 2024 or 2025, looked at their diminished portfolios, looked at their elevated living costs, and realized they had no choice. They either go back to work now while they're still healthy enough to be employable, or they face running out of money in their 80s when returning to work is no longer an option. This is a rational financial decision driven by structural forces, not by personal failure. Now let's talk about the 3 categories of financial pressure that are converging to create this crisis, because understanding these will help you see whether you're at risk. The first is inflation persistence. The Federal Reserve and most economists assumed that once supply chain disruptions from COVID resolved and once the fiscal stimulus wore off, inflation would return to the 2% target quickly. That hasn't happened. Core inflation, which excludes food and energy, has remained sticky in the 3 to 4% range. This is partly due to structural factors like deglobalization, labor market tightness, and energy transition costs that are not transitory. For retirees, this means that the elevated cost of living is not going back to pre-2021 levels. It's the new baseline, and it continues to grow from here. A retiree who budgeted for 2% inflation is now dealing with a reality where their money buys 10 to 15% less than they planned just 4 years into retirement. Over a 25-year retirement, this compounds into a devastating gap. The second category is healthcare cost acceleration, which we've touched on but needs to be understood in its full scope. The Kaiser Family Foundation tracks healthcare costs for Medicare beneficiaries, and their data shows that average out-of-pocket spending has increased by 42% over the past decade. This is not just premiums. This is the actual cost of care, the deductibles, the co-pays, the medications, the services Medicare doesn't cover. For someone with multiple chronic conditions, which becomes increasingly common after age 70, the annual cost can easily exceed $20,000. And there's a quiet mechanism here that most people don't understand. Medicare Part D, the prescription drug benefit, has a coverage gap often called the donut hole, where once your total drug costs exceed a certain threshold, you're responsible for a much higher percentage of costs until you hit catastrophic coverage. For retirees on expensive medications, hitting the donut hole means suddenly paying thousands of dollars out of pocket in a single quarter. This creates cash flow crises that force people to make choices between medications and other necessities, or to go back to work to afford the coverage gap. The third category is longevity risk, which sounds positive but is actually a financial time bomb. Life expectancy for a 65-year-old in the United States is now approximately 84 years for men and 87 years for women. But those are averages, and for people who are healthy at 65, the probability of living into their 90s is significant. A 65-year-old couple has a 50% chance that at least one of them will live to age 92. This means retirement plans need to be stress tested for 30 years, not the 20 years that many financial plans assume. A portfolio that's designed to last 20 years and runs out in year 21 leaves a retiree with potentially a decade or more of life with no financial resources except Social Security. The math is unforgiving. If you retire at 65 with $800,000 and withdraw $40,000 per year adjusted for 3% inflation, and your portfolio averages 6% annual returns, you'll run out of money around age 85. If you live to 92, that's 7 years with no portfolio left. This is why so many retirees are going back to work in their late 60s and early 70s. They're trying to delay drawing on their portfolios, trying to build a buffer, trying to create a few more years of safety margin. Now let's talk about the employment landscape for older workers, because going back to work is not as simple as it sounds. The labor market has changed dramatically, and while there is demand for workers, the types of jobs available to people in their late 60s and 70s are often lower-wage service positions, not the professional roles they may have left. According to the Bureau of Labor Statistics, the most common occupations for workers age 65 and older are retail sales, administrative support, education, and healthcare support roles. Median wages in these categories range from $15 to $25 per hour. For someone who retired from a management or professional position earning $80,000 or more annually, returning to work at $20 per hour is a significant psychological and financial adjustment. But for many, it's the only option available. There's also the question of how long they can continue working. Physical and cognitive decline accelerates after age 70, and many of the jobs available to older workers are physically demanding or require long hours on your feet. The average tenure for a retiree who returns to work is approximately 4 years before health issues force them to stop again. This creates a narrow window where they can generate additional income, and if they don't maximize that window, they're back to the same unsustainable math that forced them to return in the first place. Let's discuss the structural factors that make this different from previous retirement challenges, because what's happening now is not just a cyclical downturn, it's a systemic shift. The traditional three-legged stool of retirement, Social Security, pensions, and personal savings has effectively become a one-legged stool for most Americans. Defined benefit pensions, which provided guaranteed lifetime income, have almost entirely disappeared outside of government employment. According to the Employee Benefit Research Institute, only 15% of private sector workers have access to a defined benefit pension today, compared to over 60% in the 1980s. This means retirees are entirely dependent on their ability to manage their own investment portfolios and generate income from assets they've saved. For most people, this is a skill set they don't have and a responsibility they're not equipped to handle. The shift from defined benefit to defined contribution plans like 401ks transferred all the investment risk, longevity risk, and sequence of returns risk from institutions to individuals. And the data shows that individuals are not managing this well. The other structural factor is the erosion of real wage growth over the past 2 decades, which has made it harder for workers to save adequately in the first place. Median household income adjusted for inflation has been essentially flat since the year 2000. Meanwhile, the cost of housing, education, and healthcare have all grown faster than inflation. This means that the cohort reaching retirement age now had less capacity to save during their working years than previous generations. The rule of thumb used to be that you should save 10 to 15% of your income throughout your career to achieve a secure retirement. But when housing costs are taking 35% of income and healthcare is taking another 10 to 15%, there's simply less left over to save. The result is a generation of retirees who are underfunded not because they were irresponsible, but because the math didn't allow for adequate savings while also covering the cost of living during their working years. Now let's talk about what this means for you if you're currently planning for retirement or already in retirement. Because the point of understanding this is not to panic, it's to make informed decisions. The first thing you need to do is stress test your retirement plan, not for average inflation, but for the inflation you will actually experience. Go through your budget and weight each category by your actual spending. If you're spending 20% of your budget on healthcare and healthcare costs are rising at 6% per year, your personal inflation rate is higher than the CPI. Run your retirement projections using your real inflation rate, not the 2 to 3% that most financial plans assume. This will give you a much more accurate picture of whether your savings are adequate. The second thing you need to understand is sequence of returns risk and how to mitigate it. The most dangerous period for your portfolio is the first 10 years of retirement. If you can avoid large withdrawals during market downturns in those first 10 years, your probability of success increases dramatically. One strategy is to maintain a cash buffer of 2 to 3 years of living expenses in stable, liquid assets. This allows you to avoid selling stocks or bonds at depressed prices during a downturn. You draw from the cash buffer until markets recover, then replenish it. This simple strategy has been shown to increase portfolio longevity by several years in back-tested scenarios. The third thing is to reconsider the 4% rule, because while it's been the standard for decades, it was developed in a different market environment. The 4% rule is based on historical data that included periods of much higher bond yields and more favorable equity valuations than we have today. In today's environment of lower expected returns, a more conservative withdrawal rate of 3 to 3.5% may be more appropriate, especially in the early years of retirement. This doesn't mean you can never spend more, but it means starting lower and adjusting based on portfolio performance and market conditions. The fourth action is to optimize Social Security claiming strategy, because this is one of the most underutilized tools available. For every year you delay claiming Social Security beyond your full retirement age up to age 70, your benefit increases by approximately 8%. That's a guaranteed real return that's extremely difficult to replicate in the market. If you have adequate savings to bridge the gap from retirement to age 70, delaying Social Security can increase your lifetime income significantly and provide much more inflation-protected income later in life when you're most vulnerable. For a couple, coordinating claiming strategies where the higher earner delays to maximize the survivor benefit can add hundreds of thousands of dollars in lifetime income. The fifth consideration is healthcare planning, because this is where most retirement plans fail. You need to model not just Medicare premiums and typical out-of-pocket costs, but also long-term care costs. The statistics are clear. Roughly 70% of people over 65 will need some form of long-term care, and the costs are substantial. If you don't have a plan for how to fund this, whether through long-term care insurance, self-funding, or Medicaid planning, you are taking on enormous risk. For many people, purchasing long-term care insurance in their 50s when premiums are still reasonable is one of the most important retirement planning decisions they can make. For others, setting aside a specific portion of their portfolio as a long-term care reserve makes sense. The key is having a plan rather than hoping it won't be necessary. The sixth element is understanding that retirement is not binary. The traditional model of working full-time until 65 and then stopping completely is not the reality for most people anymore, and that's okay. A phased retirement where you transition to part-time work or consulting for several years before fully retiring can dramatically improve your financial security. It allows you to delay drawing on your portfolio, delay Social Security, and continue earning income during the most vulnerable sequence of returns period. This isn't failure. This is smart financial planning in an environment where the rules have changed. Let me bring this to a conclusion with the question that matters most. If 22% of retirees have already been forced back to work, what percentage of current pre-retirees are headed for the same outcome? The data suggests the answer is significantly higher than 22% unless there are major changes in behavior or policy. According to the Federal Reserve's Survey of Consumer Finances, the median retirement account balance for families aged 55 to 64 is approximately $185,000. If we assume that generates $7,400 per year in income using a 4% withdrawal rate, and we add the average Social Security benefit of $23,000, we're looking at total retirement income of roughly $30,400 per year. The Bureau of Labor Statistics reports that average household spending for people aged 65 and older is approximately $52,000 per year. That's a $21,600 annual gap that has to be made up somewhere, either through continued work, spending cuts, or drawing down assets faster than is sustainable. The math doesn't lie. A significant percentage of people currently approaching retirement are not financially prepared for a 25 to 30-year retirement in an environment of elevated inflation and rising healthcare costs. This is not a message designed to scare you. This is a message designed to prepare you. The retirees who are returning to work now are the ones who didn't run these numbers 5 or 10 years ago, who followed conventional wisdom that turned out to be inadequate, or who experienced market timing or health issues that disrupted their plans. You still have time to adjust. You can stress test your plan with realistic assumptions. You can increase your savings rate. You can adjust your retirement age. You can optimize your Social Security strategy. You can build a healthcare cost buffer. You can create a more conservative withdrawal plan. All of these adjustments made now can prevent you from being part of the next wave of retirees forced back into the workforce. The structural factors driving this crisis are not going away. Inflation is not returning to the low, stable levels of the 2010s. Healthcare costs are not going to stop rising faster than general inflation. Longevity is increasing, which means portfolios need to last longer, and the stock and bond markets are not priced to deliver the same returns we saw in previous decades. This is the reality we're operating in, and the sooner you accept that and plan accordingly, the better positioned you'll be. The 22% of retirees going back to work are showing you what happens when the plan doesn't work. Learn from their experience. Adjust your plan now. Run the numbers with real assumptions. Build in buffers. And understand that a successful retirement in this environment requires more conservative planning, more flexibility, and more attention to the details than it did for previous generations.